A man gets a raise, celebrates for 1 week, and then realizes nothing in his life actually got easier. His paycheck is bigger, his grocery bill is bigger, his rent is bigger, his car insurance is bigger. Even the small things feel different now. Coffee, eggs, gas, a quick lunch, a repair bill he used to ignore. On paper, he is earning more. But in real life, the money is moving like it has a hole in it. Nobody had to steal from him. Nobody had to change the number in his bank account. The money simply lost strength while he was trying to live a normal life. That is what inflation feels like when it stops being a headline and starts sitting inside your kitchen. Most people do not notice inflation all at once. They notice it in tiny moments. A grocery cart that looks emptier. A rent renewal letter that feels insulting. A restaurant menu where the old price is gone. A gas pump that turns normal errands into calculations. A parent saying, "We'll get it next time," even when the item is not a luxury. Official numbers matter, but daily life has its own scoreboard. The official number tells one story, the receipt tells another. Imagine last year you earned $100. This year, your boss gives you $103. That sounds like progress. But if the things you buy also become more expensive, that raise may not be a real raise. It may just be your paycheck trying to keep up. That is the difference between money and buying power. Money is the number. Buying power is what the number can actually do. That is why a person can work harder, earn more, and still feel stuck. The raise arrives, then the bills arrive faster. Inflation is sometimes called an invisible tax, not because it is voted on like a normal tax, but because it reduces what money can buy. If $100 used to fill the cart, and now it only fills part of it, the number on the bill did not change. Its strength changed. And the dangerous thing is that this does not feel dramatic at first. People adjust quietly. They buy cheaper brands. They delay repairs. They stop eating out. They use credit cards for things they once paid for in cash. They tell themselves it is temporary, but when temporary lasts long enough, it becomes a new lifestyle. Inflation is not equally painful. A wealthy household may complain about prices, but still keep buying. A middle-class household starts trimming. A lower-income household may have no room to trim at all. That is the cruel part. The people with the least flexibility usually feel inflation first. If most of your paycheck disappears into rent, food, transport, and utilities, then rising prices do not feel like an economic concept. They feel like fewer choices. And if you own assets, inflation can sometimes lift the value of what you already own. But if you mainly depend on wages, inflation can make you run faster just to stay in the same place. That is why inflation can widen the emotional distance between people who own assets and people who only earn wages. One group watches prices rise. The other group watches survival get more expensive. Now comes the part that sounds boring until you realize it touches almost every bill in your life. Interest rates. When inflation stays too high, the Federal Reserve often keeps interest rates higher to cool demand. That means borrowing money becomes more expensive. A family renting money for a mortgage pays more. A business renting money to expand may slow hiring. A government borrowing through bonds faces higher interest costs. A credit card balance becomes harder to escape, so inflation creates a trap. If rates stay high, borrowers suffer. If rates fall too early and inflation comes back stronger, shoppers suffer. Either way, the household feels the pressure. Not always immediately, but eventually. The real problem is not just that prices are rising. The deeper problem is that many people's lives were already priced too tightly before inflation hit. Inflation did not create every financial weakness. It exposed them. A family already stretched by rent feels food inflation harder. A student already worried about debt feels higher rates harder. A small business already surviving month to month feels supplier costs harder. A worker already living paycheck to paycheck feels even a small price increase like a warning sign. This is why inflation can look moderate in a report and still feel brutal in real life. Because people do not pay bills with averages. They pay with whatever is left after the last bill. At first, people ask, "Why is this so expensive?" Then they stop asking. That is when inflation becomes normal. The coffee shop price board changes and nobody reacts. The grocery bill crosses a new line and people just sigh. The rent increase arrives and the family starts searching for something smaller. The credit card minimum payment becomes part of the monthly routine. This is how money loses value without a dramatic scene, not with a crash, not with a siren, but with millions of small adjustments. A smaller cart, a longer receipt, a delayed dream, a quiet decision not to buy something that used to feel normal. This is not about panic, it is about awareness. Watch the gap between wages and prices. Watch housing costs. Watch energy prices. Watch interest rates. Watch how much of daily life is being paid for with debt instead of income. And most importantly, watch whether people are improving financially or just adapting to pressure. Because there is a difference. Adapting means surviving the new price. Improving means the money actually goes further. Those are not the same thing. The most dangerous thing about inflation is not that prices rise. It is that people slowly forget what normal used to cost. One day, the higher price stops feeling shocking. The smaller package stops looking strange. The bigger bill becomes expected. And the paycheck, even when it grows, still feels late. By the time the family notices the money has changed, the receipt already knew.